Trump announces 30% tariffs on European Union and Mexico. Trump said, Mexico has been helping me secure the border, but what Mexico has done is not enough. Mexico still has not stopped the cartels who are trying to turn all of North America into a playground. But despite this headline, the stock market is not too phased. You can actually see the NASDAQ has regained all of its losses over the weekend. Russell's actually in the positive and the Dow Jones holding up just fine alongside the S&P 500. Gold, however, has moved lower here. Bitcoin is at 120,000, which is insane, but giving back a little bit of its gains this morning, and oil is down slightly to 68.3 for WTI. Dollar index largely unchanged. So the big question for stock indices traders might be, why is this not getting more attention? But the market is a fascinating place. It has this weird phenomenon that it typically does, where a new threat gets a lot of attention, but an old threat starts to become less and less impactful to day-to-day market volatility. Is there a possibility in all of this headline and these uncertainties around tariffs that this does ultimately cause another market freakout? It's possible, but I would say that it's diminishing more and more as time goes on because the market is very used to all of these tariff headlines. At first, the market was very unprepared, unready for these kind of ultimatums being thrown out, and now it's like the new norm. And the stock market has found a way to push past this and pay more attention now than ever, it seems like, to strong company earnings, interest rate cuts from the Fed, and an apparent willingness from the Trump administration to go back to the negotiation table when necessary. Some people call this the taco effect, saying that Trump always chickens out. Other people just saying that Trump is negotiating his way through all of this. Regardless of what your thoughts are on Trump, the point that I want to make about this is that the market is much less concerned because it seems like ultimatums and, worst case scenarios in terms of trade completely locking up and gridlocking across the world doesn't seem like a very likely scenario. So the stock market has kind of moved past all this. While the VIX is up slightly today, you're still talking about a VIX that is in a strong decline here recently. You had the VIX jump up big time on all the tariff uncertainties when they initially came out, but now we've got a VIX under 20 at 17. This is suggesting that the market, specifically the options market, does not see a whole bunch of volatility coming. Take a look at gold prices and you can see this is also kind of saying the same thing. You've still got this thing sort of going just sideways. We haven't really made a big push in either direction, although in my view, this still does favor the upside simply because we're in a very strong longer term upward trend. The dollar index also seems to still be stubbornly moving lower, which has largely contributed to that bullish trend we've seen this year in gold. And just as a reminder, gold is absolutely smoking the performance of the S&P 500 this year. If you had bought gold at the beginning of the year versus bought the S&P 500, which is this pink line here you can actually see that the overall returns of gold this year have been significantly better, up over 27% at the time of recording this. But had you bought the stock market, you're up about 6.5%. Gold has thrived on all of the uncertainty surrounding the Trump administration and the changes that they're putting into place, but also the idea that a weaker dollar from rate cuts coming down the pipeline could continue to bolster gold higher. Taking a look at the commitment of traders report, we can see what institutions bought in the previous week. Specifically, there was some accumulation of the NASDAQ, the euro, the New Zealand dollar, and copper, believe it or not, which I find especially interesting considering copper had a huge pop last week. Did institutions know something? On the sell side, we had SPX, Dow Jones, the Japanese yen, the Nikkei, silver, Canadian dollar, US treasuries, Russell, the Australian dollar, and oil. Oil down another 1% today. As long as oil prices remain calm, this is definitely a good thing for the inflation story, as a dramatic rise in the price of oil can disrupt prices in terms of the supply chain. If you think about it, if energy costs go up, so too does the rest of goods and services. But oil prices remain muted here and don't seem to be too much of a threat at this time after seeing a bit of a ceasefire take place in the Middle East recently. Here's a look at the EdgeFinder's top setups currently. What we can see here for bullish assets is we have the NZD JPY, Euro CAD, Swiss yen, NASDAQ, Euro yen, NZD CAD, DAX, Dow Jones, Euro versus British pound, the FTSE, and the Euro dollar. In terms of our bearish assets, we have the pound against the New Zealand dollar, the dollar Swiss franc, the pound Swiss franc, CAD Swiss franc, Aussie Swiss franc, the Australian dollar versus the New Zealand dollar, the Euro Swiss franc, and the pound dollar. I want to take a look at the pound dollar because it's on a move to the downside here today. So here's the British pound on a daily chart, and this does look to me like a trend that is still very much intact. However, it is close to testing a major area of support at the time of me recording this video. In fact, even though the EdgeFinder is getting a bearish reading, what this means is that the collective of sentiment scoring, technical scoring, and economic data scoring that the EdgeFinder does automatically is generally suggesting more weakness than strength. However, that does not mean necessarily that the pound dollar has to just drop straight from here. In fact, what it means is just that the general directional bias based on the indicator set that we use, the economic data, etc., is pointing towards bearishness for the pound dollar. However, how I would actually potentially set up a trade on the pound dollar would be looking for a break of support, such as a break of this 1.3446 level. If we can see something like that and a true failure at support in combination or in confluence with the fundamentals and sentiment data that we're getting from the EdgeFinder, that could actually produce a trade setup for me. But as it currently stands, the pound dollar still seems to be in a strong uptrend. Another setup that I'm interested in is the bullish setup on the NASDAQ. But the issue here is that the NASDAQ is very stretched to the upside and probably not very close to a setup for me. Specifically, I'd be looking for a bare minimum pullback to the 22,000 level on the NAS 100 or a pullback greater down to this 21,400 level, let's call it, on the NASDAQ. These would be setups where I could potentially take a stab at getting long, looking for a continuation play in the direction of the dominant uptrend. There's two quick examples of how I use the EdgeFinder to find trade setups. And if you don't have a copy of the EdgeFinder, now is the best chance to get one. We're currently offering 40% off the EdgeFinder for our summer sale event, and all the details can be found in the description down below. Additionally, if you're interested in getting access to the EdgeFinder, but the software product is outside of your budget at this time, send us a direct message using the first link in the description below. By clicking that link, you'll be able to speak directly to a member of our support team and ask them about payment plans if that's something that you need in order to make the tool accessible to you based on its price. The EdgeFinder is an incredibly powerful tool. However, we are aware that the tool is expensive, especially for people in places where the US dollar is quite expensive. It's expensive, but it's valuable. So don't miss your chance to get it at the lowest possible price of the entire year with the links in the description below. Speaking of trades that I found through the EdgeFinder, here's a look at the Russell 2000 position. I know I've been talking about this one a lot, but it is the first and foremost kind of task on my to-do list right now in terms of my day-to-day job as a trader. And what I mean by that is my primary goal right now is to continue to monitor this position and trail stops when it is appropriate to do so. I've trailed stop losses several times on this position since initially taking the trade. And now at this point, I'm sitting in a position where I can't lose on the trade, right? I'm going to make money. It's a question of whether or not we can get another continuation push, in which case I can actually trail the stop further. So it's a question of how much money can I make from the market, not whether or not I'm going to make money anymore, which is a really good position to be in, but it's really important that I don't drop the ball and that I truly play this the way I'm supposed to. From here, what I'm looking for at the very least to get another trailing stop going would be a breakout through this previous high. If you get a strong break and closure above, I will look to trail my stop loss and tighten it up further. And I'm all out of my German DAX position. I did end up taking profits here this morning as my initial trade, which started out here, tested the limits of my stop loss, but missed it narrowly, turned around and ended up closing for about a 1-to-1 risk to reward for a profitable trade. I'll take it and move on to the next. In terms of my gold position, I'm still in this one and it has been like watching paint dry. It's gone really, really sideways. We did get a good push here on Friday, but failed to follow through at least so far today. If we can get a strong closure above this level, then just like with my Russell trade, my plan is to take my stop loss and trail it in just below this previous swing low. So I am looking to trail stops on gold, but not really in a big hurry. And in fact, the position on gold kind of plays the role of a hedge in my portfolio if we get some sort of geopolitical flare up or something crazy with Jerome Powell being, stepping down or something like that. It plays a little bit of a hedge in the portfolio at this time. Taking a look at some currencies here, the euro dollar seems to be pulling back. Would be interested potentially in a euro dollar long around 1.16, but would get more interested if we started to get like 1.13, 1.14 coming into play for a long side continuation of this upward trend. When looking at the top setups page, specifically only the economic data, which I like to look at for currency trading, we have some strong currencies like NZD CAD, Kiwi dollar, Euro Aussie, and Euro CAD. Euro Aussie is actually an interesting one for me, as I like the chart. If I can pull this one up, I'm sorry, Euro Aussie, if I pull this one up, we could see that it looks like it's pulling back here a little bit. If we get a move to like 1.7650, this might be an area where I establish a long position on this trade. I do like the upward trend on this chart, and it looks very strong overall. On the bearish side of things, I already have an AUD NZD short position, but would look for a possible second trade if we get a further extension higher in the price. Here's a look at the Australian dollar versus the New Zealand dollar. And as price pushes higher, I would actually be interested in a second entry on my existing short position if we can get a push up into the 1.125, let's call it. I'm sorry, 1.102 level. This area here looks interesting for a possible secondary short position to add to my initial position short. One of the reasons I like this pair is that it is very choppy, back and forth, and low volatility. In other words, it's a very boring currency pair. And for a mean reversion style that I like to trade when it comes to currencies, looking for overextensions and trading back and forth, I do love currency pairs like Euro Pound, the Australian dollar versus the New Zealand dollar, CAD Swiss, etc. Speaking of Euro Pound, this is a position that has gone against me and I'm still working with the trade. I really don't mind holding through this because my position sizing is so tiny and I do have a dollar cost averaging approach that I like to use in Forex. If you'd like to explore that in more detail, I'll leave a link in the top right hand of your screen right now.
All right, man, let's make a bet. Whoever gets funded first, the other person has to pay him $100.
All right, I'm down.
Sweet. With my new fair value gap, triple witching, timing strategy, you stand no chance.
Okay, I just got funded.
What? How? We just started.
With Maven's new instant funding program, you can get funded for just as little as 19 bucks. They offer some of the best industry pricing, fast payouts, and you can trade pretty much anything on their prop firm. If you'd like to check out Maven's instant funding program, the link and information can be found in the description below. You owe me $100, man.
Come on, man. That's not even fair.
Hey, Nick, the COT data has been showing selling the RTY or the Russell. Why are you still expecting short-term longs? Samuel, it's a great question. Like, totally fair question. COT shows selling. Why are you still long? And a lot of times we get that question because a lot of times people, they really love the COT report. And I get it. I do too, right? But the COT report is not the end all be all, the only thing that I consider. There's a lot of reasons I really like the Russell. For example, I think we're going to get rate cuts this year. The Russell is small cap companies that lower borrowing costs would really help. Additionally, I think the jobs market looks okay and you got cooling inflation. It's a good environment for the Russell. So even though institutions may have sold a little Russell here, right? In fact, they're very bearish on the Russell. First of all, institutions are not always right, believe it or not. However, even if they are bearish on the Russell, it does not mean that that is the only thing that I look at to guide whether I'm bullish or bearish on something. In fact, I would actually discourage you. There are a lot of people who do this, so I'm just fair warning. There's a lot of people who just say, look, institutions are bullish on yen. So I want to be bullish on yen too. And there's a lot of people who do that. And that's cool. But to me, I think there's more to look at than just the commitment of traders data, especially when you understand that, okay, you want to be, let's do an example. Ready? A lot of people, Swiss franc, Japanese yen. You ready? Here's why looking only at the COT data is not a great idea. It is a useful tool. Do not get me wrong. I love the COT data, but it's not a holy grail. If we look at the Swiss franc and we said, okay, we wanted to short Swiss franc with institutions. We wanted to buy Japanese yen with institutions, right? That's what the institutions are doing, right? Here's Swiss yen. What did we say? We wanted to short Swiss franc and buy Japanese yen. Do you see what I'm saying? That was a really poor thing to try and copy your way into, right? So while institutional data is useful, institutions also are not the same as you and I. They may have shorted a little here and 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 shorted a little here. And they may be playing for a 6 months out reversal in Swiss franc against the Japanese yen. This may be how they ultimately play the trade. So COT data is good for a big picture, but it's not great for like an instantaneous, oh, every day it's going to go in the direction of COT. It's not like that, right? It is a useful tool. It's something I consider. But if we look at the top setups, the way this page is laid out, notice that only one column is COT data in consideration. All of these collectively matter way more to our scoring algorithm than the commitment of traders data. Now, again, some traders really prefer to only look at the COT report, and that's great. You do your thing. But for me, COT data is just one piece of the puzzle. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.